and online. And we'll get to everybody to introduce themselves in a second, but we're really excited. This is our first event of 2026. We took a little break at the end of the year last year and just did a little traveling, Sarah and I. So we're back and we have a full year of events planned. So this is only the beginning. So yeah, we're going to be talking about infinite banking, and what I love about this strategy that I've just learned about over the last year is you can have your money working for you in two different places. So that's what Theresa on screen up in the top right will be talking to us about. She's our guest speaker.
Hey, Suzanne, sorry to interrupt.
Yeah.
Cynthia's trying to get in. Can you approve her?
Thank you. Sometimes, hey, there's other people. I don't see her yet. It usually takes a little notification.
All right, I'll see what I can do.
Okay, so just let me know. I'll add her as soon as I get the little thing. Yeah, so we'll be talking about infinite banking, and then Larry Smith is a guest speaker of Theresa's. He's another one like me who has invested in infinite banking, and he's got a lot more experience than I do. So yeah, he'll be talking about his experience. He also gave me confidence when I was evaluating this opportunity for some of my capital. He shared some of his stories, so it was helpful for me, and I hope it will be helpful for you. So I think you all know who Sarah and I are. We're the ones in the corners here, black and white. For those of you on the screen, there we've got Cynthia, and we are realtors here. You're in our lovely office in our classroom training room, and we also have the Central Oregon Investor Network, which is what we do to bring everyone together who's learning about investing and on various ends of their journey, whether just beginning or starting to sell off or doing private money lending. We cover it all. And Sarah and I are both investors. So between the two of us, we are invested in multiple states. We have a property in Mexico. But you could say we're even international investors. And we've done flips, long-term rentals, short-term rentals, house hacks, lease options. What else have we done? I think that's the majority of it. Creative finance. I bought two properties and done some creative financing, like seller financing as well. So yeah, we've done a lot of it, but we haven't done it all, and we're still learning. And those are the people that we're bringing in to learn from ourselves and to help educate the rest of the community. So that is about us. Anything else you want to add, Sarah?
No, thank you.
Sarah's working.
Suzanne, you're still doing the private money lending too?
Oh yes,
yeah.
Did I not say that? And also private money lending, which is actually what I use this for. Hi, Christine. Yeah, so that's what makes the infinite banking piece really good. Lending my money, and it still grows. Okay, so our agenda today, Teresa's going to talk to us about what infinite banking is and is not, how you can use it strategically, how to grow your money in the policies and then deploy it at the same time. But she'll explain how you actually do that. Why traditional financing, so bank financing, can potentially drain your wealth, and who this is best suited for and not suited for. So it's really good for self-awareness of how we are with our finances and how we deal with money. So Theresa will talk about that. And then we've got some contact information at the end so that you can connect with Theresa if you want to talk to her about these policies or rural program and learn more for yourself. So we love to do intros. So we're going to keep it snappy because we have lots of people, which makes me so happy. I love having a full room. Let's do online first. So Theresa, you'll get to introduce yourself in a second, but yeah, let's have you start, Larry, and then we'll just go down the line. Oh, are you there?
You talking to me?
Yeah, Larry, you want to just introduce yourself really quick?
Oh, sure. Yeah, I'm Larry Smith. I'm out of Sulphur Springs, Texas, and Theresa and I have been close friends for about 16 years. And I'm a product of this product that she's going to talk to you about today. So I'll wait till my turn and go from there. Very nice seeing you, Suzanne.
Great, thanks for joining. All right, Didrik, welcome. Good to see you.
Cool. Yeah, good to see you again. I'm also here with my wife, Cynthia. She's also online. And yeah, we've been, I guess, just a quick version, bought our first duplex about 20 years ago in Portland. And we've kind of gone up and down as high as maybe 4 to 5 properties at one point. And now we're just have 2 duplexes, one in Portland and one in Bend.
Nice. Glad to see you. Cynthia, do you want to add anything?
That about sums it up. Yep.
Good to hear your voice. We've got Brittany. Welcome.
Hello, can you hear me?
Yes.
Okay, so I'm in Tacoma, Washington. I'm an experienced investor managing a residential, multifamily residential. And today I just want to learn something that I don't know.
I love it. Well, thank you for joining us.
Yeah, thank you.
How about Jonathan Lindquist? You're muted if you're talking. Oh, can't use your mic. Okay. What did he say? Living off my investments. Yeah, good for you. And you're invested interested in the topic. Got it. Sounds good. Thanks for putting your inputs in the chat. All right. Well, Brody, there's a Brady here too. So we were a little confused here and there. That's Brody.
So Brody, my wife Jessica, and have Baxter Builders. So I do a lot of building and I've done some development, but not really like property management or investing. So just here to learn about that.
Yeah, nice.
My name's Katie. My husband's not able to be here, but we're new to the investment world as of about a few months ago. So heard about this group through Barbara Walker and just wanted to get connected and learn about a new topic, meet some other people. So
We got a room full.
Yeah.
Yeah, good. Make sure to introduce yourself at the end.
No, okay. Peggy, Kimball, I'm a realtor here also in Redmond, and I've done a PML fixes and flips for about the last 6 months. So love doing it.
I'm Sheree, and I started investing in 2023 using the slow flip method, which I have 9 properties right now in the Midwest. Almost had 10, but I declined. And I'm also involved in private money lending, and I know about infinite banking and just want to keep learning more about it.
I'm Brady. I work for Calcon during the day, but my wife and I properties fixed up. Working on our primary right now that we've talked from Suzanne and Sarah about a year and a half ago. Yeah.
It came with a cat.
Came with cat.
Yeah.
She's the best. She's our greeter. Yeah, well, they do on the property and it's all our gas. It's awesome.
I'm Holly. I've been learning about investing since 2023 in all different sorts of ways, and real estate's definitely one of them. I've done a couple of flips and now have one of them turned into a bird. So I have that one up in Cornelius. The next target market is not in Oregon for lots of reasons. I'm also launching a service that is called a listing babysitter for agents and investors to help fill gaps for times where you'd like somebody to go do something at a property that you don't want to do and you don't want to pay big bucks for. So,
So cool.
Yeah. Yes.
Yeah.
Yeah. It's something that I saw a gap when I was doing the investing and flipping thing, and I was like, oh, going through the Rolodex, who can I get to come out here at this one, but in it. So I thought, hey, I could do that. I could do that. I could be the one-stop shop. So anyway.
So good.
Yeah.
Last year you were teaching us about AI.
Yeah.
for real estate investing now.
Yes. The AI thing went to the wayside when my stepdad had his heart attack, and then because that was very, since then he's passed away. So I was like, oh, I have this void. I need to fill it with something. And I love service, so this is going to be a good. It's going to be good. Something I can get my kids involved in eventually. So yeah.
I'm John, and I live out near Tumalo. I've been here about 8 years. I've been to several of these meetups. They've always been great, educational. And I have, limited experience, but I do have an investment property in Ohio, which I still manage, and looking to get more out of this, or looking to get more educated about how to use infinite banking. And I've heard another term called whole life insurance, which I guess is kind of the same thing. So I just want to learn more about how to make my money work for me.
Well, I'm also John, and I also have a place in Pamelo. Last name is Deskamp. I've been in lending, banking, finance my whole career. Also an investor myself in several multifamily partnerships, which is kind of a nice entry point if you want to learn how it works and see how the cash flows work, etc. And I work for a company called Conventus. We do fix and flip, round up in the SCR all over the country. So, and I've used versions of what Theresa is going to talk about, but borrowing against securities versus life insurance policies. And a lot of times have clients who actually do a combination of their own cash and one of those strategies as well. So they're not mutually exclusive.
Yeah, love it. Good.
Hi, I'm Bryn. I'm in Three Rivers area. Bought my first short-term rental last year in Seaside. And I'm also an attorney, trained in litigation, but looking to move into estate practice.
Oh, yeah.
Have a room block with a real estate attorney. So
Yeah.
In multi-state. Midwest, multi-state.
I know. You want to say anything, Jessica?
No.
All right.
Piggyback off of him.
And then Christy.
Hi, I love because I never knew Baxter Builders was you guys. That's what I love about these meetups. It's good to know. I'm Christy Jesperson. I'm a real estate agent here in Central Oregon. Been part of the community for 20 years, and Suzanne and Sarah are my mentors for the past year and a half. And yeah, super excited to learn more about. I've also heard of it as term life insurance, so excited to hear more. So,
Perfect. Okay, Theresa, we are going to hand it over to you, and I'll just advance the slides. You just tell me when you're ready, and we'll keep things rolling.
Perfect. Can you all hear me okay? Can you hear me okay?
Yes.
Yes. Okay, perfect. Well, what a lively group. Very happy to be here. Suzanne, thank you so much for the invitation. I do not take these opportunities lightly. I've actually been working in finance for over 40 years. I was a bit of a different child when I was in high school. My father, who was a doctor, real estate investor, entrepreneur, shared with me his balance sheet and his deals and the investments that he was involved with. And I fell in love with the concept of money. And went to University of Miami, got my degree in finance, then went to law school, and in 1993 went back to working in finance. I started with a Wall Street firm when I was in college. So it's been over 40 years in finance, which is a crazy amount of time, and still going strong. Have a great team here in Austin. I discovered infinite banking, bank on yourself, whole life insurance, 100-year real estate investor, which is my brand. Living Wealthy Financial is my brand. I discovered it over 25 years ago. And back then, we did not have the internet to do research, certainly not like we do today. And I became my own first guinea pig client, set up a policy, because before I shared it with any clients, I needed to make sure that it worked and it did exactly what I said it was going to do. Became students with the mentor, grandfather of this concept, Nelson Nash. He took me under his wing, and very, very grateful for the opportunities that I had. Even though when you're an early adopter and an early promoter of a concept, not the easiest path to travel. You are climbing up a mountain. And today with the internet, and several of you mentioned that you're familiar with the concept today on the internet, it's everywhere. So I was a bit of a pioneer, but very, very grateful for that opportunity, and grateful that I had the opportunity to start policies when I was my younger self, and also some on my son. My focus with my clients today is really education, helping them set up their policies, and coaching them and utilizing the policies to get the most that they can from the policies regarding whatever strategies they're working with. I do work with a lot of real estate investors. I also work with business owners, and both groups have very unique needs and stresses, let's say, that come up. Real estate investing, as you all know, whether you're doing private money lending or fix and flips, short-term rentals, long-term hold, each come with their challenges. You're going to hear me share in this presentation today an analogy to the real estate property and whole life insurance. All these names that you're hearing, Bank on Yourself or Infinite Banking Concept, they're names of a strategy, but the product that we're working with is whole life insurance. And whole life insurance is nothing exotic. It is a bit complicated to understand, but simplifying it, just pretend I'm talking about, in many ways, like a real estate property that you've invested in, because there are many, many features to whole life insurance that are very similar to a real estate property. Now, there are advantages to whole life insurance and disadvantages to holding real estate or investing in real estate, which, as real estate investors, I'm sure you know, whole life insurance, if you want to close your policy, you don't have to wait for a buyer, right? You just close your policy. It's a lot less complicated than real estate investing. But when I use the analogy, lights up. So, Suzanne, I think we can move the slide.
I'm going to just cruise on to this one.
Yep, perfect. So we do work with whole life insurance policies, but they're specially designed life insurance policies. And the design is more focused on maximizing cash value in the policy than maximizing death benefit. Not that the other types of designs are bad. It's just for my clients and what my clients do, right? With their policies, we want to max out cash as much as possible. And the reason for that is one of the really cool, unique things about the policies is that you can borrow against your own capital in the policy, just like you can borrow equity, get a line of credit from a property that you have equity on. And when you take money from your property, you still experience uninterrupted compounding if there's growth with that real estate. The same thing happens with the policy. The difference is that the policies continue to grow no matter what. These policies, the growth is not linked to the market. It's not linked to real estate. It's not linked to the S&P. It is linked to the performance of the insurance company. And the insurance companies that we work with have been around for over 200 years and do not or have not ever missed 1 year in paying dividends. They are considered tier 1 assets by the Federal Reserve, which means they are in the basket of assets that are the safest asset out there. So unlike real estate, which sometimes doesn't continue to grow, right? The policies continue to grow no matter what. And when you borrow from your policy, that interest and dividends that are growing in your policy goes back into your system, so to speak. These policies again, have been around since, the concept of have been around for over 200 years. There has not been one company of the type of companies that we work with that have ever failed. So again, going back to the tier 1 asset, very, very, very safe asset for you to build equity and then use as a source of financing for your real estate projects. Suzanne?
All right.
So continuing with the comparison between real estate and whole life policy, I'm going to focus on the middle column, the capability of these assets. Both assets build equity over time. As you feed your policy, and by feeding it, I mean as you pay into your policy or you save into your policy, right? Your equity grows. Your real estate, once you buy it, typically you're not feeding into the real estate. The market itself will help it appreciate. But as you pay down your loan, if you have a loan, you may increase the equity on the property. You can borrow against the equity in both assets. Both assets can continue to grow while leveraged. You can deploy that capital, use that leverage into more investing if you choose to. Liquidity with your policy is extremely high, and most times you can get a loan, like a line of credit from your policy, in less than 3 to 5 business days. With real estate, unless you've got a line of credit set up, sometimes it can take some time, and obviously you have to qualify. As far as control, you are the policy owner. You are completely in control of that contract. Unlike real estate, depending on whether you've got a line of credit, a lender, the market, etc., other partners, you may not have complete control. The predictability is very high. Again, it's considered a tier 1 asset by the Federal Reserve, which is the gold standard. That is the highest ranking that you can have as an asset with the Federal Reserve. Predictability is very high. Liquidity, you've got 2 ways to access liquidity. One is to tap into your cash value. The other is to die. When you die, your beneficiaries actually get access to the death benefit. Risk mitigation. As far as risk is concerned, with real estate, of course, you've got market and leverage risk. With the whole life insurance policy, in many jurisdictions, states, you've got complete asset protection, much like you would with a homestead. It is state dependent, and I do business all over the country, and some states have incredible asset protection with these policies. No creditor can ever touch either the cash or the death benefit. Other states are not so liberal when it comes to asset protection. And in terms of opportunity leverage, that death benefit can provide liquidity to beneficiaries when they inherit a property and they need to support the property. With real estate, of course, the opportunity leverage can be constrained by credit and, of course, market timing. Suzanne?
That's great. Any questions?
I have one.
Yeah.
Hi, Theresa. If there's a loan outstanding at death, would that be subtracted from the death benefit of the policy?
You got it.
So that would actually be a great advantage for the estate to not have leverage, say, on a piece of real estate and have to service that while they're going through probate or whatever.
You got it. I've got a slide coming up that says, I don't care about the death benefit. I don't want the death benefit. I'm going to cover that, but the death benefit can solve a lot of problems. So if you've taken out a loan to purchase a property, right, from your policy at death, that loan is erased. That property was free and clear. There was just, the loan on the policy. But once the death benefit pays, there's no more loan.
But it's reduced by the amount of the loan that you took.
It is reduced. So if your death benefit is $1 million, the loan is $200,000, the beneficiary gets $800,000.
And no loan to deal with.
Nice. Yeah. Okay. That's super helpful. Good question, John.
So I've got a couple slides that give a concept regarding the process and what can be done. I can speak hours and hours and hours on this concept. And it can be a little bit complicated, but as real estate investors, if we go back to thinking about the policy as real estate and what you can do with a line of credit on real estate, just replace that with the concept of money in a savings account. That savings account just happens to be wrapped up in life insurance. And that type of life insurance is whole life, right? And again, a very specific design of whole life. So if we look at this slide, we'll start with the high cash value whole life policy, where it looks like a bank. It could also look like a house, sort of, kind of, right? And first you have to you've got to build up the equity into that policy. So you see the dollar sign right before that bank. That's you just paying into the policy. You can do that on a yearly basis, monthly basis, quarterly basis. There are multiple ways of funding that policy, right? Then let's say you've built up some equity and you identify an opportunity. We'll just say private money lending, because most people understand that. Super simple, right? Let's say you've got a private money lending opportunity at 12%, right? They're going to pay you 12% for your money. So you're going to take out, let's say, $100,000 to keep the math easy. You're going to lend it out and earn 12%. So basically what you're doing is you're taking a line of credit from your policy, your $100,000, you're borrowing against that policy's death benefit. Okay. So the insurance company is looking at your death benefit as the collateral. Why? You die, they're collecting.
Mhm.
So it's just super simple, right? For them. So you've got the cash value sitting in your policy. They're not going to lend you any money above the cash value that you've got in your policy, but the collateral is the death benefit. So you borrow that $100,000, you do your private money lending, you get paid back your 12% plus your principal. You just pay that back into your policy. You can do that over and over and over again. Now, if you had taken that $100,000 from a savings account, you'd still, do pretty good. You've got your 12% from your private money lending investor. But what you're missing out on is the opportunity cost of that money that you took out of savings that's no longer growing and working for you. Well, when you take that money out of the policy, that $100,000 out of the policy, that money continues to work for you as if you had never taken it out. You've got what we call uninterrupted compounding. Sure.
So is that compounding, if you're taking out 100,000, what are you compounding on, based on?
100,000.
Okay, so it's just like, I don't want to say fictitiously there, but because we're taking the money out. So it's just growing on the 100,000 that you are going to be paying back, but it's growing anyway.
So I'll get in the weeds a little bit. From the insurance company's perspective, they've got two bookkeeping ledgers. They've got one ledger that's showing I'm using the word deposit. It's not a deposit. It's a payment into your policy, but I'm using that for simplicity. So they're looking at the deposits that you've made into the policy. They're looking at the growth into the policy, right? And when you got to the $100,000 number, they're looking at that from a cash value perspective. They're continuing, even though you've taken out a loan, they're continuing to pay dividends and interest into your policy as if you had not removed that 100,000. Why? Because there's another department, that's the investment department of the insurance company. When you decided to take out a loan, it's the investment department that got involved. They looked at the collateral, right? The death benefit, the $100,000 that you've got sitting in your account, and they lent you your money, right? Your $100,000, but it's coming from the investment ledger, not from your cash value ledger. So they're lending you the money from the investment division. They are charging you interest. So two things, your ledger on your cash value continues to grow, but they are charging you interest. if we had time today, which we don't, if we speak personally, I'll show you a spreadsheet that outlines exactly what's going on with the interest that you're paying to the insurance company and the uninterrupted compounding that you're getting on the other hand in your cash value. With private money lending, you're actually coming out significantly ahead.
Thank you.
Of course. And the other thing that I'll say, we are talking about real estate. It is a real estate investors meeting. I have thousands of clients and they use these policies to not only invest in real estate, not only to fund, capital for their business, inventory, et cetera, but they buy cars with it. They pay off debt with it. They buy other investments. They bought crypto. My family's bought a tree farm, which we've been heavily invested in real estate for a long time. Right now, we've got just a couple properties in a tree farm, which the cool thing about tree farms, FYI, you're buying the land and you're buying a business, right? So that property actually puts out a significant amount of money because the land is appreciating, plus you've got business that's providing dividends on a monthly basis. My son bought his bride a beautiful engagement wedding ring when he got married. He's got a business with 12 trucks on the road. And as he increases the business and brings in more employees, he's got to buy more trucks. Well, he has financed his trucks from his insurance policies, from his infinite banking policies. He could have borrowed the money from a bank, but why is there a bank on on every street corner downtown, in every town, every county, every state in the country? It's because banks make a ton of money financing. Well, instead of my son paying that interest to third party, he keeps that money working for him in his policies. So even though we're talking about real estate, Nelson, again, the grandfather of the infinite banking concept, he named it, he titled it Infinite Banking because the uses and the way of using these policies is truly infinite. And every week I'm surprised by an idea that a client has in a way that they want to use their policy. It truly is infinite. But again, we're talking about real estate here. But keep that in mind. You can use this for many, 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 many different reasons. Suzanne?
Hi, Theresa. How is the death benefit amount determined, and is there a cost for that? Like traditional life insurance, you pay a premium every month and you have a certain amount. So I'm just wondering how that works.
Yes. So there are benefits to these policies from a tax perspective that are available because the IRS says that if you're paying a premium for the life insurance, for the death benefit, then they're going to allow the money inside of these policies to grow income tax free. So there is a cost to the death benefit. It is inside of the policy. The way we design the policies is we keep the death benefit as small as possible to allow as much cash as possible to go into the policies. But we can't design it where the death benefit is almost free, right? The IRS has guidelines and says if you try to do that, they're going to tax you on the growth. So the cost of insurance is dependent on how much money we want to put into the policy on a regular basis, your age, your health, your sex, male or female, right? So that cost is determined and is individual. It's based on each person, how they're rated from a health perspective.
That answer your question?
Yeah.
Okay, cool. All right. Moving on.
Okay, so here's just another slide to show the journey, right, of working with the infinite banking concept. Left-hand corner, this might be you, right? You fund your policy. We use a specific type of life insurance company. They're called mutual insurance companies. Very similar. The analogy I use is banks and credit unions. Banks are chartered to improve or increase shareholder value. Credit unions are chartered to increase member value. in the benefit of like extra interest that you might get or lower interest rates on loans. Mutual insurance companies versus life insurance companies that are stock companies. Well, the stock company is chartered to increase the benefit of the shareholders. Mutual insurance companies are designed to increase the benefit of those that own policies. And they do that in the form of dividends. Life insurance companies, the kind that we work with, are actually quite profitable. And what they do in the form of dividends is share the profits back with the policyholders. So they're not, there's no shareholder class that's profiting. It's the insurance policyholders that are profiting from the profits from that the insurance company makes. So you establish your policy, right? And then once your policy is funded, then you can take out loans. The whole loan process is quite flexible. And this is where a lot of the coaching comes in. When I get started with a client, there's an educational process in terms of, having them understand how the policy works and what we can do with it. And there's a design process. And then once you have your policy, then there's an education component to, hey, how are you going to use your policy in a way that can enhance and optimize what you're doing with your money? Okay. So it's a case by case basis, but let's use an example that you're going to buy a property that you're going to fix and flip, and you use the money that's in the policy as your down payment for that property, or maybe not down payment, just to buy the property and then flip it. I teach you how flexible it is for you to pay back your loan. In many circumstances, you're the banker. You decide how you're going to pay back the loan, the terms of paying it back, the interest rate that you want to pay yourself back. I have many clients that will pay themselves extra interest to put back into their policy because as investors, there is a cost to money. And so they want to enhance the performance in their policy by paying themselves extra interest. We've got major expenditures and strategic investment opportunities. Those are all the different ways that you can use your policy, right? And for our purposes today, we're focused on, of course, real estate. Going back to that example with the fix and flip, once you sell it, once you flip the property, you can pay back your loan. You've now refilled your bucket in terms of the equity that was in the policy. Your policy continued to grow, remember, because there was uninterrupted compounding, and you can do this over again and do it over and over and over again.
So cool. Mm-hmm. Okay.
How do investors actually use it? I go back to the infinite banking concept, really infinite uses. After working with this for over 25 years, again, I'm surprised on a regular basis how people think of ways to use it. When it comes to real estate, anything that you can do with real estate that you need capital, you can use it with these policies. Suzanne?
Okay.
Mm-hmm. I don't care about the death benefit. I hear this a lot. Now, the IRS gives these kind of policies special magical powers, let's say, because way, way, way back, before the 1913, our Congress wanted to incentivize people to take care of their families. And so they did this by, and I think we're going around 1913, when the Federal Reserve and the IRS Code was enacted. They wanted to promote families to take care of family members when someone died, right? And so back in, I think it was the 80s or the 90s, when Senator Roth came up with the idea of the Roth qualified plan, right, for money to be invested and it grow income tax free, he actually copied whole life insurance. And he did that because the banking industry and the securities industry could not compete with how whole life insurance was designed. So because there is a death benefit, we get benefits that really no other financial vehicle can offer you. And what it does is, for your estate, it provides immediate liquidity, right? Someone dies, an investor dies. Most investors, they have complicated balance sheets, right? Especially if you're an active investor and you've got loans outstanding and you've got loans on different properties, and you might owe, a private money lender. Like investors, like business owners, they have complicated lives. I've never had a beneficiary call me up and say, Theresa, I'm so mad that I just got a check for $2 million. I can't believe that they wasted that money on the death benefit of the insurance policy. If anything, and unfortunately in the last 10 years, I've had more clients pass away than, the rest of my career. I've always heard, Theresa, I wish I had set up more. I wish I had listened to you earlier. And I'm not saying that, I'm saying that humbly. And I say that from the perspective, as my clients get older, their opportunities to start policies, right, diminishes because of age or health issues, right? And I should have done a better job explaining what the opportunity was with these policies and maybe encourage them to get more policies when they were younger. These policies and the death benefit liquidity can offset a lot of business and investment timing risk. I've had clients use these policies and the death benefit to assign to a third party so that they could do business with a third party, either borrow money, get involved in a business. I'll give you a quick example. I had a client who was a very, very wealthy man, but did not have a lot of liquidity. And he needed to raise some money for one of his ventures. And one of his partners required that he assign the death benefit on one of his policies just in case he passed away. That partner would have been made whole because the partner felt that the only way this venture was going to succeed was if this person, lived. And if he died, then he wanted to be made whole. This client actually was a partner of mine in this business. We had a brand called the 100-Year and the 100-Year Real Estate Investor. And unfortunately, my partner developed pancreatic cancer at a very young age. And December of 2023, he passed away. Well, he was able to sell that venture because he was able to secure the partner's funds with the death benefit. And before he passed away, he still had that venture and was able to sell it to a third party. The partner who invested with him was made whole by the sale, and whatever was left over, he got from the death benefit. So very unusual case. No one would have imagined that he would have gotten pancreatic cancer, especially as vibrant and healthy as he was. But he did. And he was one of my dearest friends and clients who said, why didn't I buy more? Why did I buy more of this? But anyways, the last thing I will say, and it goes back to Rick, as many of everybody that I know, right? All of my clients and just everybody that I know in the business world and real estate investing world, we all make mistakes. We all fail forward, right? I don't know one investor, one business owner who has not made significant mistakes when it comes to finances. It's amazing how that death benefit helps provide money to the estate to make up for lifelong mistakes. If the death benefit was $1 million or $2 million, and somebody looks back at their life and say, I lost $30,000 with this scam artist, and that property that I bought, I lost so much money in it. that $2 million or whatever that amount is going back into the state more than covers the mistakes that we as real estate investors and business owners make in our lifetime. What I tell my clients when they're approaching, when they've got significant illness and they've got regret and they talk, and with my clients, as Suzanne's discovered and Larry will share, I become dear friends with my clients. If that's not all of them, but that's the relationship part is what I so appreciate more than anything else. And the coaching that I give them is, make sure that you teach your kids and those loved ones and the people around you about all your mistakes, because that mistake may have cost you $1 million or 100,000 or 50,000, but you get to amortize that mistake with the lesson and the wisdom that you learned to multiple generations. Right? Why are you going to die with that mistake and having nobody else learn from that mistake? And that was something my father taught me in high school. And I have a son and a nephew that's like my son. And I share my balance sheet with them. I share my net worth statement with them. They know exactly how much I make. They know how much my investments make. They know everything. And they know about all the stupid mistakes that I make. Very early on in my career, I did not have a bookkeeper. My son is 29, my nephew is 40. Years ago, when they started their business, one's in real estate, one is in HVAC and mold remediation here in Austin. Got them the bookkeeper and I paid for it. Why? Because entrepreneurs, business owners, investors, for the most part, are terrible, terrible bookkeepers. Finding a good bookkeeper is not an easy feat. I had one that I've been working with for a very, very long time. I actually have two. I have a firm and I have a personal bookkeeper. And just having a meeting with a bookkeeper on a monthly basis keeps you connected to your numbers, where you can see, okay, I spent too much here. What am I doing? Right? Or look at how my investments have grown. Larry, who you're going to hear from in a minute, actually looks at his numbers every single morning and updates his numbers every single morning, right? So all that, I know it's a bit of a sidetrack, but if you have kids or if you have friends and partners, share your losses, your dumb mistakes, along with your wins, right? So important to do that. That way we get to amortize our losses to future generations. I'll get back on the slides. Suzanne?
Love it. That was a great point.
Okay, going back to the death benefit. If you've got a death benefit, if you're trying to make a deal, close a deal, and somebody's not sure, you can offer them part of your death benefit, right? Hey, listen, I want to give you some comfort, Mr. Venture Partner. If something were to happen to me, I want to assign the death benefit to you for, to cover this investment. So if God forbid something happens to me, you know that you're going to be made whole, right? That is such a strategic advantage in business that nobody utilizes. Obviously, you protect your family and partners while your capital stays deployed, and preserves family wealth when outcomes are imperfect. We live in an imperfect world. We're imperfect people, and there's no perfect deal. It just, there's always that opportunity that you could have done better. You could have done something different. But that's where we give ourselves grace and move on. Suzanne? Okay, what infinite banking is not. Remember, infinite banking is a strategy. We're using a product, right? So what infinite banking is not, it's not traditional life insurance. I can't tell you how many policies I look at on a regular basis where people think, they listen to some YouTube guru who sold them a policy and the policy was not properly designed. It is not get rich quick. Rick and I had a strategy, or had a brand called 100 Years. From a branding perspective, marketing perspective, probably wasn't the best brand to work with, because we live in a get rich quick society. Who wants to wait 100 years, right? So from a branding perspective, wasn't great, but it certainly filtered out people who philosophically were not in alignment, right? This is not get rich quick. really funny. On a regular basis, I get calls from prospects who say, hey, I want to set up a policy because I want to be able to borrow from my death benefit. And I'm like, I'm not sure where you got that info, but it's not correct. You don't start a policy and get to borrow from the death benefit. You only get to borrow from the equity that you have established in your policy. But that is a common misnomer that's out there. You can not borrow from your death benefit. The death benefit is collateral for the loan from the insurance company. It's not for someone who doesn't have an investment or saving mindset. It just isn't. If you're living way above your means, I've got clients that I help, that, that there are a lot of people living way above their means. If they're committed to making changes and building their balance sheet, I'm committed to helping them. But if they're not committed to that, we're not in alignment. And this is not a scam. Now, I added that to the slide for a couple of reasons. And I asked Suzanne permission to share our story. When Suzanne and I met, she had heard about this concept. She was interested in it. A client of mine, a longtime client of mine, had referred her to me. And, she started a policy, a beautiful policy, great design. And it went against, I think, and Suzanne, tell me if I'm wrong, if I'm telling the story wrong, against a college friend of hers who was in the financial services business, who told her, this is a scam, don't do it. Like, you're being scammed, right? And so, as I do with all my clients, Suzanne and I stay pretty much in contact. And we had our review, an annual review. And, she seemed really sad and concerned that she had been scammed. And thankfully, she very openly and honestly told me, hey, I feel I've been scammed. After thousands of clients, I can tell you, none of my clients have ever told me that, at least to my face, right? They may have thought that at some point, but they never told me that. And I just felt so bad for multiple reasons. One, because I knew what she had was absolutely not a scam. But number two, she was not appreciating what an amazing asset that she had. And I offered to her to speak to two of my clients who have done a lot with their policies over the years. I rarely offer that because I don't like bothering my clients, to offer testimonials, et cetera. But she was very open, and I introduced her to two of my clients. One is Larry Smith, who I asked to join us today. And the other is John Grubiak. John Grubiak, very, very wealthy man who I met maybe 15 years ago, who retired very young and invested in real estate, did a lot of private money lending. And I introduced him to Suzanne because he was very much involved in real estate. And he and Larry win the awards for being the biggest pain in the butt when it came to researching this concept. Literally took years before they committed to working with me. Not exaggerating. And both super bright men. And John did his homework, and his son is here in Austin. We have dinner a couple times a year. And the last time I saw him, he said, you've changed my family's life. Now, this is a very, very wealthy man who absolutely loves his policies and what he's been able to do with it in terms of doing the infinite banking concept with his private money lending. Suzanne got to speak with him. Suzanne also got to speak with Larry. Larry is one of my dearest, closest friends and longtime client. We met, again, a referral. Sorry, it's an alarm. And Larry, won the award for a long time of being the biggest pain in the butt when it came to researching this concept. Larry is a self-made man, made a lot of money, lost a lot of money, made a lot of money, lost a lot of money, and is absolutely on top of the world today. proud to say. And I, invited him here today to speak a little bit about what this concept has done for him, how it's not a scam, and just happy, Larry, that you agreed to join us today.
Well, thank you, Theresa. I appreciate it. It's been enjoyable to listen to you, and I apologize if there's an echo. I'm actually at a hospital in Dallas right now with my daughter, so I apologize for doing that. But I wanted you to. It was enjoyable to listen to this conversation and Theresa sharing this with you all, because I remember about 16 years ago when I first started hearing about this from a referral from a friend, just like Suzanne was a referral. And I kept saying, Theresa, you can't do all that. You can't do all those things. It's just too good to be true. And, so I researched and literally spent 2 years researching. And the only thing I'm frustrated about is that I lost 2 years of the benefit of the bank on yourself policy. But once I finally understood the entire complex, and Theresa was so good the whole time, never pushed me. All she did was saying, read this book. She'd send me a book, read this book, read this book. And finally I went, after I heard 130 years of consecutive growth, I went, I've never seen anything that's had 130 years of consecutive growth. So I went ahead and said, I'm going to buy a policy. So I bought a policy for myself. I started using that policy and having incredible things happen. I bought a second policy for myself because I wanted another one. Then I ended up buying one for my wife. I bought one for my son. I bought one for my daughter. And now the greatest gift I can give all my grandchildren is every time I have a new grandchild, I put a bank on yourself policy at birth because they're cheap, because they're brand newborns, right? And you can set them up for their future to where they'll never pay. Think about this. If you never paid 1 penny of interest in your entire life, how much would that check be worth, right? And that's what you can set your grandkids up to do. So I'm a firm believer, but more than importantly than anything, I think I want to share some of the ideas I had about how to use this. Again, I apologize for the background noise, but the first way I used it was I bought a BMW. I bought a really pristine shape BMW that was 3 years old. And if you think about how do you normally buy a car? Well, you either finance it or you take money out of savings or maybe borrow it against a CD and pay interest on your own money. There's a lot of different ways to do it. But if you pay cash, then you take the money no longer works for you. So you take the cash and pay the car. Well, you're not paying interest on that loan, but you're losing the interest that the money was earning by taking the cash out of that asset. So with Bank on Yourself, I borrowed it against my policy, and then I turned around and paid the money back on my schedule. I can say, hey, I want to pay $100 a month, $1,000 a month. I want to pay $300 every quarter. This month I'm still tight on cash flow. I don't want to make the payment this month. Or I can not even set up payments. I can just pay it when I want to. Anytime I want to make a payment towards that loan, I can do that. So it gave me, the point I'm making is it gave me all the flexibility to work within my terms of cash flow to be able to do that. So I bought my car first. And then if any of you all, I'm sure most of you know who Grant Cardone is. Well, Grant, and I invested in Fund 5 with Grant. I think he's now up to 26, but I invested in Fund 5 with Grant, and I took the money out of my Bank on Yourself policy, one of them, and invested into Fund 5 with Grant Cardone. I've bought other property with the cash flow. I made a $50,000 investment in one pre-IPO, which unfortunately didn't work out. I borrowed $250,000 for a pre-IPO for another company that I'm now getting money every month on a 3-year payoff that's paying me 3x. So the 250, I'm getting 750,000 in return over a 3-year period, and I got that money right in my Bank on Yourself policy. So I've had no loans that I've had to pay monthly towards that. All the money that comes in, I'm putting right back into my Bank on Yourself policy. My whole point is there's so many different ways you can use this. And listen, I'll be, and I'm not getting paid a dime whether anybody does anything with this or not. So I'm getting to tell the real story, right? And that is that if I wish I'd have done this earlier, because I think 44 or something, maybe a little older than that, 50 something when I bought the policy. But if I'd have bought it in my 20s or 30s, it would have cost me a lot less because of my age and my ability to qualify for insurance. And today, it's still working in ways that are unimaginable. And at the time, because interest rates were different, I'll give you an example. I was paying 5% interest on the loan, but because my equity, my asset was still working inside the policy, the dividend I was getting paid was literally paying me a higher percentage on the dividend than what I was paying interest. So in effect, they were paying me money to borrow my own money on my own repayment terms. I can't tell you enough great things about it. I did have a wonderful conversation with Suzanne, and I'm not saying this because she's sitting there, but I converse with people all day long for a living, and I can tell you, Suzanne, that's one of the most pleasurable conversations I've had in a long, long time. You're personable, you're knowledgeable. You've got energy, you've got excitement about where you're heading, about what you've already accomplished. And thank you, Suzanne, for such a wonderful conversation. And Theresa, thanks for having me on. And all I would tell you is it's a great thing to have in your portfolio. Theresa, back to you.
Thank you, Larry. So good.
Thank you. Isn't he amazing? And I recommend the book, Dare to Get Rich. We're not here promoting a book, but Larry's story is so inspiring, so incredibly inspiring. And maybe Suzanne can have Larry on as a guest speaker because his story is just incredible. Rags to riches, to rags to riches, to rags and riches. I don't know, Larry. I don't know how many times you've done that, but you're staying at the top and just twice. Okay. Well, for many people, once is enough, right? But you managed to do it several times, and the gift and the legacy that you've built with your family, with your children, with your business partners, with your friends like myself, it really is priceless. And you leveraged some pretty difficult times into amazing wisdom and amazing life with a beautiful, beautiful family. So,
well, thank you, Theresa. I appreciate it. Just remember, good judgment comes from experience, but experience comes from bad judgment. So you got to make the mistakes in order to get the knowledge and the wisdom to grow right. And I will tell you all that Theresa and I, we become great friends because she's been a great value add, if you will, to my entire family's legacy. And it's not the reason we're good friends, but she's got so much wisdom, so much knowledge about how this works. And anytime I have a question, I can, sit down and have a Zoom with her real quick and just chat with her about how the best way to handle this is. And she's a real valuable asset in this entire process. And I can't tell you how many people I've referred to Theresa over the years, but I haven't had one single one come back and say, "Oh, that was really a bad decision." Every single one of them. I travel across the country. I just came back from Denver. I'm heading to California shortly here, and every time I go, I see people I refer to Theresa, and every one of them says, "I can't tell you how grateful I am. I had no idea that thing would grow the way it's growing," and it's just, it's just a wonderful experience. Thank you all.
thank you, Larry. Larry has referred hundreds and hundreds of clients to me over the years. Imagine, the relationship means more to me than anything else, right? And that's why I learned early on, this isn't about selling. This is about alignment. Does it make sense for you or not? We start with the conversation. We start with the education. The relationship means more to me than the business always has. Here is how to reach me. I do have a team of 8 here in Austin. I have clients all over the country. My cell phone is there. That's my direct number. I leverage my team, but my clients do have my direct number. I work with, clients just like you. Larry referred to Bank on Yourself. That's how he learned about the concept under that brand, Bank on Yourself, infinite banking, 100 years. There's a lot of different brands. At the end of the day, it's still the same strategy. And I think that's all I've got. We can open it up to questions and answers. And Larry, please stay if you can. Maybe
my daughter just got out of her cancer treatment, so I'm going to take off from the hospital. But thank you for having me. I appreciate it. Suzanne, look forward to talking to you tomorrow morning. Thank you all.
Thanks.
I'll leave that up, but yeah, questions.
I do. Larry kind of answered part of my question, that is taking a policy out on someone much younger than me because it's a lot cheaper. So if I did that, do I become the custodian? How do I benefit from borrowing that money?
So there are three parties to an insurance contract. There's the owner of the policy. There's the insured. I'll be a little crude. That's the body that is being insured, right? And the beneficiary. When clients own policies on other family members, I teach them to become the owner and the beneficiary. Now, Larry did say policies on younger kids or younger, the death benefit part is less expensive from an actuarial table. Of course, that makes sense, right? But I also teach my clients, and I have clients who start policies in their 80s. Okay. Why would they do that if there are younger family members where the insurance could be cheaper? Because I follow and teach the natural order of things, right? I want to insure the parents before the kids. I want to insure the grandparents if we can. I own policies on my parents. My parents are 88 years old. I bought policies on myself, my son, my parents. When I bought my policies on my parents, they were 70 years old. Who buys policies on a 70-year-old? I did. Why? Because from a natural order of things, right? Hopefully my parents will die before me, right? Hopefully I will die before my son. When my parents die, that insurance policy will give me a liquidity event that allows me to feed other investments and other policies. So you might save a little bit of money on the death benefit if you start on a younger member of the family. But if you think about generational planning and legacy planning, it's actually better to start the policy on you. And if you're uninsurable for any reason, why, then we look at other options. And I give my clients their options and choices. At the end of the day, it's their decision on which way they want to move.
I have a question. Thank you.
Holly?
Hi, Theresa. I have 4 policies.
Yay!
And on 3 of my kids. They don't have hundreds of thousands. They have tens of thousands. Some of them just thousands.
Amazing.
I wish I had done it a long time ago. Right now, I'm the beneficiary, but I hear people saying that you can make a trust the beneficiary, and that way, not only are there rules around how that money will be spent after you're gone, but then it's just more of a family wealth model instead of just me. How do you feel about that? Is that something you prescribe to?
So I do have a legal background. I do not practice law. I am licensed to practice law. I work with a lot of really super smart attorneys. My legal background gives me an understanding of certain legal concepts that somebody without my background wouldn't have. I actually have one of my colleagues who designed a multi-generational dynastic trust for just the reason that you're talking about. I'm of the opinion, and we could talk about this one-on-one if you'd like, I'm of the opinion that wealth can be controlled after you die and actually should be controlled after you die. You can talk about, or you could look at the Rockefellers and the Vanderbilts as a perfect example of wealth that is controlled and wealth that is not controlled. The Vanderbilts were one of the wealthiest families of their time, and in 3 generations, the family is completely broke because they did not control the wealth from the grave. The Rockefellers have very strict control from the grave, and their family will be one of the wealthiest families in the world for many, 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 many generations to come. The multi-generational dynastic trust that I designed was just for that reason, to help my clients with the death benefit that's in the policies, right? Fund policies into the future and put rules in the trust as to how they can use that cash that's in the policy. So congratulations on starting those policies. And yeah, I'm all for controlling that wealth.
Yeah, Theresa, can you front load the premiums into the policy so you don't have an annual premium?
You can front load it if you're talking about front loading it so you have no other premium payments ever. That's tricky, and I have strategies that can do that, but there's still going to be a cost of insurance every year, whether you're paying it out of pocket or not. But yes, with my real estate investors, we design front-loaded policies all the time.
I personally have a whole life insurance policy, but my children don't. I'm curious about what it would look like if can one transfer a policy from one company to another in some aspect? Can you dip out of one and come into another? Is that not a good idea because it was done years and years prior when I was younger?
So what I do is analyze policies because, obviously people have policies before they met me, right? And I analyze policies and I become the advisor on the policies that we keep. And if it makes sense, only if it makes sense, and we compare apples to apples, right, to see if it makes sense, we can replace those policies. And there's a specific way of transferring those policies over. But if we can preserve a policy, I'm always about that. And what we do is we just put that policy and work with that policy as a portfolio of policies. And I teach you how to optimize what you've got if you keep your policy.
Great, thank you.
I have a question. How does the whole life insurance differ, and how is it similar to a HSA, health savings account?
So a health savings, it's actually a completely different animal, right? The health savings account, I actually think is an amazing strategy to work with. And if you've got health benefits and can fund a health savings account, I absolutely recommend it. The investment, and I'm not investment licensed by design, so I'm keeping this high level, but I would put the investment into, the S&P index, right? Just super simple, and fund as much of that as possible to fund your future medical expenses. As we're all getting older, right? And unfortunately, I see this a lot in my practice as people get older, all this money and wealth that they accumulate, they end up spending a part of that on their health, right? And the health savings account, I think you get triple benefits from a tax perspective. You get the benefit of the money that you put into the health savings account. It grows income tax free, and you can take it out income tax free. So it complements what we do. It's not a replacement. Now the difference, and I do have clients that use their policies for long-term care or health care, because part of the death benefit can be used while you're living if you have health issues, right? So the death benefit is not just for, when you die. You can actually access that pool of money when you're living if you have some major health issues, right? But I've got clients that are real estate investors, business owners who do not have traditional health insurance, and they don't qualify for an HSA. So we use the policy as a reserve for medical issues that might come up.
Thank you.
Another one. I'm full of questions. Can you use, or what would your advice be to roll over R1 that no longer needs to be with an employer, that you can actually take it and utilize it? So we're kind of at a crossroads of what to do with that, whether to do a Roth, self-directed Roth, or even infinite banking. What would your take be on that?
So it really is a case-by-case basis. Happy to look at the numbers and your options with you. I've got software that analyzes whether you keep, the money in an IRA versus converting to a Roth, how much money you can save in taxes, et cetera. Remember, taxes are on sale today. We are at historical low levels of taxes, even though it may not feel that way. And, with our debt, climbing and all the crazy things that are going on in the world, I don't think we're going to have, low tax rates for much longer. I think it's got to catch up with us. So if you're going to make, a change, now might be the time to do that. And happy to go over your options. And I'm all things finance, right? I've got a lot of experience in finance. I have expertise in very specific areas. But generally speaking, I can speak all sorts of languages with finance, and I have an amazing network of professionals that I refer my clients to depending on what their needs are. So, I may not be an expert, right, when it comes to certain things in finance, but typically I can point a client in the right direction.
Question. Hi, Cynthia, or Teresa, sorry. But, from my understanding, once you open a policy, you're committed to making those payments. I know Larry touched on it briefly, like if finances change, what are the implications if you can't make a payment?
Great question. So the way we design our policies, we design them where you have to make a commitment for a certain number of years, right? If you don't think you've got funds for the next 3 to 5 years, then it's not possibly a good fit, right? But after 5 years, most of my policies can support themselves. So you're not making a lifetime commitment of paying into the policy. And if you front loaded enough or you pay into it enough, right? One of the sayings I use is, serve your policy, support your policy in the front end so it can support you in the back end. One of the really, really cool features about these policies is, flexible premium payments, right? There's a lot of flexibility as to how much you can pay into the policy or when you can stop paying into the policy. All the growth is income tax free. And many of these policies are supporting my clients in either supplemental income, tax free, or reserve that they can tap into for other investments and other things that they want to do. All that growth is income tax free. Death benefit is income tax free. So we look, we could sit down, look at your situation, where you think your cash flow, your income is going to come from, and you'll see the numbers. If you don't fund it after 5 years, what will the numbers look like? Obviously, it's not going to be as high as it would be if you funded it, forever. When Suzanne started her policy, I work with a lot of spreadsheets. I show the numbers, and those are very specific numbers that I show. I want you to see worst case scenario. I want you to see the minimum amount you need to fund your policies. Why? Crap happens, right? Life happens. And I want you to see, hey, if life happens and you can't pay, for whatever reason, this is what the policy can do. If you have, all these amazing windfalls and all this money that you could feed your policy, this is what the policy can do.
Hi, you kind of just touched on it, but what are some other reasons someone wouldn't do this? It sounds great for a lot of reasons, but what are the risks or downsides?
The downside is, I'll say, and I screen my clients and I filter my clients and discuss things with my clients when it comes to, starting a policy. If they don't have a lot of reserves outside of their income, if they've got a corporate job, and they don't have a lot of reserves or they have a lot of debt, it may not be the best time to start a policy, because I want to set my clients up to succeed, not to fail. So if someone's got a lot of debt, doesn't have any savings, has a corporate job that they may or may not lose, they're not a good candidate to start a policy. If you're a real estate investor that is basically, scrambling just to pay your basic necessities, it may not be a good fit for us to start a policy at this time, right? If you're philosophically, from a value perspective, not about the long term, get rid of strategy that can support for all of your finances. But if you want a return immediately, this is not it.
Cool. Thank you.
Yeah, helpful. We had a slide for that. We were ready. Any other questions online? Cynthia?
I guess maybe just to, really tighten that last piece of, if you don't have a big chunk of cash up front that would make sense for you to borrow, the policy probably doesn't make sense.
Well, so no, not necessarily.
$1,000 of cash value, that doesn't really help you very much.
I missed that last part. What's the amount?
1,000.
Right. It wouldn't make sense. Right. So I've got kids policies that have, a small amount. And I teach the parents, have them buy their own computer, have them buy their own cell phone if they want to buy a cell phone. Teach them how to bank on themselves, right? Use the policy as a bank instead of using, credit or third-party bank, right? Clients, from the smallest policy, it's about $500 a month, all the way up to millions a year that I have clients that actually put into their policies, and everything in between, right? For me, no policy is too small, no policy is too big, both sides of that and everything in between. It really is about, I've had very wealthy clients start a small policy just to understand how it works, right? Hey, I'll start a smaller policy, see how it works. I've had clients borrow money within 3 months, not a lot of money, because they wanted to see, okay, can they really take out money? Does it really work the way I said it did? But if you're looking to just borrow $1,000, what are you going to do with $1,000, right? A child buying a phone, or maybe if you want to buy a phone, it might make sense. But if you don't have a lot of money to work with and you do, let's say, $500 a month, in a couple years, that adds up. And even if it's you just replace a generator, buy a generator, or replace your HVAC system or whatever, it allows you to keep that money working for you. And it's, like all things finance, the compounding effect, you may not see it in 2 years, 5 years, 10 years, 20, 30 years makes a huge, huge difference.
Good question. What does your preliminary consult look like?
Typically it's 30 minutes, and I just get to know you and see if we're a fit, answer any questions you might have. If you're not very educated on the concept, Suzanne will tell you, I send you books at my expense. Why? Because I want you educated. And you and I do not have enough time in the world, in the day, for me to pour in everything that I know. So I invest in you if you're interested, and I send you books to read. Typically 2 books are what we work with. And I'll know by your questions in our follow-up meetings whether you actually did any reading or not based on your questions. And I say that tongue in cheek, right? This is a different way of looking at money, and I want my clients educated. And the more educated you are, the more we're going to win together.
I brought both the books in case anyone wants to look at
them.
Checkout library.
Yeah, I know. Yeah. Good. Well, thank you, Theresa. I know we generally go over time, so thank you all for being here and asking great questions. And we've recorded this, so you can watch it later. You can share it with your friends, and hopefully everyone snapped her QR code that goes right to the contact page on your website, Theresa. So people can connect there, or you can just text her or email her if you want. But again, like we're not here, there's no affiliate relationship. I'm doing this because I learned a lot. I went through the ups and downs, the ups and downs, talk about like, is this the right thing to do? And I'm convinced that it is. So I put my money in it, and I'm excited to use it for the first time. So we'll be talking about what I'm going to do. It'll be private money lending for me. Yeah, I'll keep you all posted.
Thank you all for your attention. And Suzanne, thank you for trusting me and being open-minded enough to, speaking with Larry and John and doing the due diligence. And I'm so happy that you appreciate what you've got today. And really, again, thank you for this opportunity. It means the world to me.
Well, this was fabulous. Thank you.
Thank you, guys. I'll disconnect now.
Right, have a good one. Okay. Thanks everyone for joining us tonight too. We'll see you next time.
Yes.
Bye, Suzanne. Thanks.
Bye, Desiree.
Thank you.